Hello, class. Hey, earlier during the first week of the class session, we talked about the accounting cycle, and we left off with journalizing and posting, and then preparing a trial balance. I want to show you exactly what goes on throughout the accounting cycle, starting with this first page here. What you're looking at is a journal entry sheet or a journal that I prepared, and in this journal, as you know, this is where all the transactions are recorded or journalized, right? So this is the area where the normal transactions are recorded, and we have an area for adjusting entries and closing entries, which I'll talk about a little bit later. Okay. Now I set up these T accounts, okay, and these represent basically the ledger accounts. Every account that we have has a T account, and it's used to keep track of increases and decreases to the accounts in order to determine the balance. Okay. And so you see over here we have cash, accounts receivables, supplies, prepaid rent. We have a T account for prepaid insurance, equipment, accumulated depreciation, and so forth. So you see all the accounts here from assets, liabilities, equity, revenue, and expenses. You'll also notice this one account called income summary, which I'll talk about a little bit later. Okay. Over here is a worksheet I'm going to be using, and this is going to be used to prepare the trial balances. Now we're going to go through three different trial balances. One called the unadjusted trial balance. The second one's going to be called the adjusted trial balance, which is the new balances after we make adjustments. And then finally we have the post-closing trial balance. Okay, so based on a number of transactions that I worked on, I recorded all these different journal entries, right? From April 1st all the way down to April 30th, okay? For example, if you look at this transaction here, this reflects the contribution of cash, receivables, supplies, and equipment into a corporation in exchange for common stock. If you look at this transaction on the second, it looks like the company paid $4,200 um, for prepaid insurance. On the 5th, the company purchased office equipment on account. If we jump over here to the 27th, it shows that the company paid a salary expense of $1,650 and they paid cash. Okay, so these are examples of the journal entries that we discussed in class. All these journal entries are going to be posted into the ledger accounts. So these numbers here you see in the cash accounts, these debits and credits, the debits and credits and accounts receivable and every other account are coming from each journal entry that we recorded earlier. Okay. At the end of the month, we're able to figure out what the balance is or determine what the balance is for each different account. Okay. As you look at fees earned, the company earned in the month of April $57,500. It records the total expenses. It has a record of all the miscellaneous expenses, right? From there, a trial balance or an adjusted trial balance is prepared. And so these numbers here are coming from each T account or ledger account, right? All the accounts with a debit balance are placed on the debit side. All accounts balances with a credit balance are placed on the credit side. Okay. As you notice, assets all have debit balances, as well as dividends and expenses, right? And as we learned in class, liabilities, equity, and revenues all have credit balances. Okay. You'll also notice that some of these accounts have a zero balance, okay, such as supplies, rent, depreciation, insurance, okay, accumulated depreciation. Well, this leads into the adjustments. See, during the month, I'm sure the company used supplies or had a rent expense or incurred some sort of expenses or earned some revenues that weren't recorded. And this is where the adjustments come in. Okay. So based on information that I had, I went ahead and recorded the adjusting entries. Okay. So I had 6 adjusting entries. And this first entry is an entry to record the insurance expense for the amount of insurance we use out of the prepaid insurance account. The second entry is a record of how much supplies we use during the month. This is our depreciation expense for the month. Transaction D, this is a record of a salary expense that was not recorded. It was accrued but not recorded. We hadn't paid the employees yet their salary at the end of the month, but we have to account for it. Here's our rent expense. So this is a portion of the prepaid rent that we used up. And then this is part of the unearned fees that we actually earned. One of our customers paid us in advance, and we earned a portion of our unearned fees. So these are called adjusting entries. Okay. From there, these adjusting entries would be posted to the ledger accounts again. So we're updating these accounts. Okay. And so you notice the items in blue here, right, are the adjustments. And so it's going to change certain accounts. So our supplies account will change. Our prepaid rent account changed. Unearned fees change as well, right? Our fees earned increased. Our salaries expense increased as well. Okay. When it comes to adjusting entries, there's some things that you have to remember. First of all, adjusting entries are made at the end of the accounting period. Second, adjusting entries do not affect cash. And third, adjusting entries always affect one income statement account and one balance sheet account. For example, when we recorded supplies expense, we also reduce our supplies account. The supplies expense is on the income statement. The supplies account is on the balance sheet. Okay. You can also look at, for example, the unearned fees. Our unearned fees is a liability. It represents an advance payment from customers, okay, for future services. Well, during the month, we actually earned part of that advance fee, and so we recorded that as a fees earned, which is a revenue account, and that is on the income statement. At the same time, we're going to reduce our liability called unearned fees by the same amount, and that is on the balance sheet. So again, every adjusting entry impacts one income statement account and one balance sheet account. From there, we prepare our adjusted trial balance. Okay. So over here in red, we see the new balances for certain accounts. The accounts that changed were supplies, prepaid rent, prepaid insurance, accumulated depreciation, salaries payable, unearned fees, fees earned, salaries expense, supplies expense, rent expense, depreciation expense, and insurance expense. Okay, some of the accounts increased and some of the accounts decreased. Okay. For example, if I look at the supplies, supplies had a balance of $4,025 and it was a debit balance, but I credited the supplies accounts by $2,800. So so 4,025 minus 2,800 gives us a balance of 1,225. On the other hand, if you look at our salaries, okay, on the unadjusted balance was $3,300 for salaries expense, okay, and we added a debit of $275, which increased the balance to $3,575. Okay, so this is our adjusted trial balance, and we notice that in our trial balances, okay, the debits equal the credits, right? In every trial balance, whether it's unadjusted, adjusted, or later on when I talk about the post-closing trial balance, the balances or the total of debits should equal the total of credits. So these numbers here on the adjusted trial balance are the final numbers. And from there, we can prepare our financial statements. Okay. So we're going to take these numbers and first prepare an income statement. And so here is our income statement showing our revenues and all our expenses. Okay. This amount here represents the total of all these expenses. And the net income, in this particular case, right, is the difference between the fees earned and the total expenses, resulting in income. Now, if the expenses were greater than the revenues, then we would have a loss. After arriving at net income, we can prepare our retained earnings statement. Right? And with a retained earnings statement, it starts out with beginning retained earnings. And I'm assuming here that this is a brand new company, so the beginning balance is 0. Now, if this was an existing company, the balance would be the amount from the end of the previous year or the end of the previous month. Okay. So we're going to start with 0, and I'm going to take my net income from the income statement, and that's going to be placed here. So that's going to increase our retained earnings. And this company paid dividends. The dividends will reduce our retained earnings. Okay. So when we take the difference between income and dividends, okay, we get an overall increase in retained earnings. We take the beginning balance, which is 0, plus 35,775, gives us an ending balance in retained earnings of $35,775. Okay. So that is the second statement. So you see how the income statement, okay, articulates with the retained earnings statements. From there, you prepare the balance sheet. Now, the balance sheet reports all the assets, liabilities, and equity of the company. Okay. Over here on the left side of the balance sheet, you see all the assets listed here. Okay. And these are all your current assets. Current assets are any assets that you expect to use up or convert to cash within 1 year. What you see next is your property, plant, and equipment. Otherwise, that includes office equipment, land, buildings, things like that. So here we take our current assets plus our property, plant, and equipment, and that gives us our total assets. Okay. Well, by the way, this account called accumulated depreciation, okay, when it comes to fixed assets like office equipment or machinery and equipment, things like that, when we first acquire an asset, those assets are recorded at cost. However, as we use them over the life of the asset depreciates, not so much in value, but in terms of allocating the cost of what we paid. And that allocation of cost, or periodic allocation of cost, is called depreciation. So every month, every year, we're going to take a portion of that original cost and depreciate it, and that amount becomes an expense called depreciation. So if you look here, this is our first year or first month of depreciation, $400. Well, if you look up here on the income statement, you see a depreciation expense for that period of $400. And every month going forward, right, this account will increase, or every year going forward, it'll increase. As the accumulated depreciation increases, and it's netted with the office equipment, the net book value, okay, the difference gets closer to 0. Here you see the liabilities, right? Accounts payables, salaries payables, unearned fees. These are all current liabilities, and these are debts that we expect to pay within a year. Any debts or obligations that are due beyond a year would be a non-current or long-term liability. And here we have equity. Okay. So our equity is made up of common stock and retained earnings. Right? And you notice that the retained earnings was determined and taken from the retained earnings statement here. Okay. Again, you see the relationship between the retained earnings statement and the balance sheet. Okay. So I'm taking my liabilities plus my equity. The sum of that gives me my total liabilities and equity. Your total liabilities and equity must equal the total assets. They have to balance. Hence, this is called the balance sheet. Okay. One of the last things that happens in the accounting cycle is the closing process. Okay. Certain accounts have to be closed. And what I mean by closed, they have to be zeroed out. Okay. We don't want those balances in certain accounts to carry over. Okay. Now again, we have 5 different types of accounts. We have assets, liabilities, and equity. We have revenues and expenses. And I should throw in a 6th one called dividends. The accounts that we close are referred to as temporary or nominal accounts. Okay? Those accounts include your revenues, your expenses, and your dividends. All the items on your income statement, those accounts have to be zeroed out. They have to be closed. We do not want those balances rolling over into the next year. Okay? However, the accounts that are never closed are the balance sheet accounts. Those are assets, liabilities, and equity. Okay? Those accounts roll over. So whatever your balance is on December 31st is, one day later on January 1st, that balance will be there. It doesn't go away. So these are the 4 adjusting entries. Like I mentioned earlier, okay, the first entry is closing revenues. And revenues are closed into an account called income summary. Income summary is a clearing account. We only use it to zero out our revenues and expenses and dividends. Okay. So we close out our revenues into income summary. Here we're going to close out all our expenses into income summary. And from there, we find the difference between revenues and expenses, and that's going to be our net income. Well, now our income summary has a balance. Okay. That balance of $53,775 also has to be closed out. And when we close it out into retained earnings. Okay. So here you see that our revenues are closed, our expenses are closed into income summary, and then we have to close out income summary. Okay. And finally, the 4th entry is to close out dividends. If the corporation paid dividends during the year, okay, those dividends are closed out and taken out of retained earnings. Okay. So as you can see, there are 4 basic closing entries. Here, if we take a look at the general ledger, okay, you'll see that our revenues, our fees earned, right, has a 0 balance. This was closed into income summary. All our expenses, each expense was closed out, right, into income summary, which left a balance. And then I went ahead and closed out the income summary to have a 0 balance here, and that number was transferred into retained earnings. Okay. If you recall, if you look at the retained earnings statement, that is our ending balance, isn't it? Okay. That's after taking out dividends. And finally, our dividends are closed. Okay. Now, dividends are closed directly into retained earnings. Dividends are not closed through income summary. Just remember that. Okay. Here we look at our 3rd trial balance, okay, which is the post-closing trial balance. After closing out the accounts, you'll notice that the only accounts that have balances are the balance sheet accounts, right, from cash all the way to retained earnings. All your income statement accounts and dividend accounts and expenses are all closed. And so that's kind of a general picture of the overall accounting cycle.